We have been conditioned to view the stock market through the lens of Hollywood. Pop culture, from The Wolf of Wall Street to Billions, has deeply ingrained a specific fantasy in our collective consciousness. We visualize the archetype of the savvy investor, someone sitting in front of a command center of six monitors, aggressively reading charts, spotting patterns that others miss, and striking at the perfect moment. It is a seductive narrative because it appeals to our vanity. It suggests that financial success is a direct function of intelligence and effort. We believe that if we are smart enough, if we work hard enough, and if we pay enough attention, we can pick the winners. We convince ourselves that with the right research, we can outsmart the herd. However, this belief is not just optimistic, it is a fundamental psychological error. It is the Dunning-Kruger effect applied to your bank account. In the world of finance, most retail investors confuse luck with skill. This is easy to do, especially during a bull market. When the entire ocean is rising, even a leaking boat will float. If you bought a tech stock during the explosive run of 2020 or 2021, you likely made money. Seeing green numbers on your screen reinforces the dangerous belief that you did something right. You attribute the gain to your foresight, your intuition, or your superior analysis. But in reality, you were simply standing in the rain and congratulating yourself for getting wet. This false confidence is sustained by a powerful psychological mechanism known as intermittent reinforcement. It is the exact same design principle that keeps a gambler pulling the lever on a slot machine. You don't win every time, but you win just often enough to keep the dopamine flowing. One successful trade can erase the memory of five bad ones. That single moment of beating the market validates your strategy and convinces you to keep playing, blinding you to the fact that over the long term, your aggregate performance is trailing far behind the average. The harsh reality is that the stock market is not a game of solitaire where you play against yourself or the board. It is a game of poker. And in this game, for every winner, there must be a loser. It is a zero-sum environment relative to the benchmark. For you to buy a stock at a bargain price, someone else must be willing to sell it to you at that price. This brings us to the most uncomfortable question in finance, one that most active traders refuse to ask. Who is the person on the other side of the trade? In the 1950s, the market was dominated by individuals. It was amateurs playing against amateurs. But today, the landscape has shifted entirely. You are not playing against a dentist from Ohio or a school teacher from Florida. You are sitting at a virtual table with Goldman Sachs, BlackRock, and Renaissance Technologies. You are betting against algorithms that operate on nanosecond timescales, managed by PhD mathematicians and physicists who have modeled every conceivable variable. When you open your brokerage app and decide to buy a stock because you read a news article or saw a chart pattern, you have to ask yourself, what edge do you actually have? The news you are reading is 3 hours old. The chart pattern you're looking at is visible to millions of other people and millions of bots. The institutional giants on the other side of your trade have access to satellite imagery of retail parking lots, real-time credit card data, and proprietary information networks that cost millions of dollars a year to maintain. To believe that you, with a smartphone and a free news feed, can consistently find mispricings that these billion-dollar infrastructures have missed is not just unlikely, it is mathematically arrogant. The belief that you can beat the market implies that you know something the market does not. But the market is a collective superintelligence that absorbs information instantly. The alpha, or excess return, that you are chasing is a mirage. You are bringing a knife to a nuclear war, and the only reason you might survive for a while is not because you are skilled, but because variance is masquerading as talent. Let us strip away the mythology of Wall Street and look at the cold, hard mechanics of the system. To understand why you are statistically destined to lose, we must look at a foundational concept in modern finance, known as the arithmetic of active management. This was formalized by Nobel laureate William Sharpe in 1991, and it is not a theory that is open for debate. It is a mathematical tautology. The logic is devastatingly simple. The stock market, in its entirety, is owned by two groups of people: passive investors who own the index and active investors who try to beat the index. Passive investors, by definition, hold a slice of the entire market. Therefore, their return is equal to the market return. Since the market is simply the sum of all passive and active holdings, it follows as a matter of mathematical necessity that the active investors, as a group, must also earn the exact same return as the market. Before costs, the average active investor does not beat the market. They are the market. However, this equality only exists in a friction-free world. Once you introduce the reality of the real world, management fees, trading commissions, bid-ask spreads, and taxes, the equation shifts. Because active investors incur significantly higher costs to trade and manage their portfolios, the average active investor must, with mathematical certainty, underperform the average passive investor. This brings us to the concept of the zero-sum game. The stock market is often described as a way to grow wealth, which implies it is positive sum. And yes, over the long run, corporate profits grow and dividends are paid, creating wealth for everyone holding stocks. But the pursuit of alpha, the desire to outperform the market average, is strictly zero-sum. For you to beat the market by 5%, there must be a counterparty who underperforms the market by exactly 5%. Alpha cannot be created. It can only be taken. Every dollar of outperformance you earn is a dollar that was lost by someone else on the other side of the trade. This forces us to ask the most critical question in investing. If you are the one winning, who is the one losing? In the mid-20th century, answering this was easy. In the 1950s, the stock market was composed of 90% retail investors, individual people, doctors, lawyers, and shopkeepers, trading on tips and intuition. If you did a little bit of homework, you could easily find a sucker at the table. You were a shark swimming in a pool of minnows. But the ecosystem has been completely terraformed. Today, that ratio has flipped. 90% of the daily trading volume on the New York Stock Exchange is institutional. The sucker has left the building. When you buy a stock because you believe it is undervalued, you are not buying it from a dentist in Ohio. You are buying it from a counterparty who is likely a multi-billion-dollar hedge fund or a high-frequency trading algorithm. This counterparty has an infrastructure that you cannot comprehend. They have teams of PhD mathematicians, meteorologists, and data scientists. They are analyzing real-time credit card transaction data, satellite imagery of retail parking lots, and supply chain logistics before the data ever reaches a public newswire. This is the terrifying reality of being a retail trader in the modern era. You are bringing a knife to a nuclear war. When you sit down at your computer to make a trade, you are betting that your analysis is superior to the collective analysis of the most sophisticated financial entities on the planet. You are betting that they are wrong and you are right. This leads to the uncomfortable truth about doing your research. Many investors believe that if they read the annual reports, study the balance sheets, and listen to the earnings calls, they can find an edge. But in the arithmetic of active management, this is a fallacy. A balance sheet is public information. The moment a company releases a report, that information is instantly ingested by thousands of algorithms and priced into the stock. If a company has great earnings, the stock price rises immediately to reflect that. By the time you read the report, the opportunity to profit from that information is already gone. You are not finding hidden value. You are simply reading yesterday's news. The belief that an individual can consistently extract alpha from this environment is not just optimistic. It contradicts the basic structure of the market. You are playing a game where the opposition has infinite capital, faster information, and lower costs. The math guarantees that the majority of active participants must lose, not because they are stupid, but because the arithmetic of the system allows for no other outcome. To understand the futility of stock picking, we must move from simple arithmetic to the physics of information. This brings us to the most famous and most hated theory in all of finance, the efficient market hypothesis. While it has many forms, the version that matters to you is the semi-strong form, which states that asset prices instantly reflect all publicly available information. To visualize this, we need to look at the mechanism of price discovery. Imagine a major pharmaceutical company announces they have discovered a cure for a specific disease. That information is valuable. It means the company is worth billions more than it was yesterday. The question is, How long does it take for the stock price to rise to reflect this new reality? Does it take a day? An hour? A minute? No, it happens in milliseconds. In the time it takes your heart to beat once, the price has already adjusted. This is because the market is patrolled by high-frequency trading algorithms. These are not people reading news wires. These are machines scanning data feeds at the speed of light. They analyze headlines, earnings reports, and economic data, and they execute buy or sell orders in microseconds. By the time the notification pops up on your phone saying Company X beats earnings, the event is effectively ancient history. The profit from that information has already been extracted by a machine sitting in a data center in New Jersey. When you buy the stock 5 minutes later, you are paying the new fair price. The arbitrage opportunity is gone. The meat has been picked off the bone, and you are buying the skeleton. Now, the skeptics will immediately point to the outliers. They will say, if the market is efficient and nobody can beat it, how do you explain Warren Buffett? How do you explain the legendary traders who consistently outperform? This is a logical fallacy known as survivorship bias, and it can be explained with a simple thought experiment. Imagine we fill a stadium with 50,000 people and give everyone a coin. We ask them to stand up and flip it. If they flip tails, they sit down. If they flip heads, they stay standing. After the first flip, 25,000 people sit down. After the second, 12,000 remain. We keep going. After 20 rounds, there might be one person left standing. Is that person a master coin flipper? Did they practice their technique? Did they have a special edge? No. They are just the statistical anomaly that must exist given the sample size. In a market with millions of participants, it is a statistical certainty that someone will make the right bet 50 times in a row purely by chance. The media will put that person on the cover of magazines, write books about their strategy, and call them a genius. But to the cold laws of probability, they are just the person who flipped heads 20 times. While true skill does exist, it is so rare and so difficult to distinguish from luck in real time that, for a retail investor, it is safer to assume it doesn't exist. Trying to outsmart an efficient market is like trying to predict which checkout line at the grocery store will move the fastest. You scan the lines, you look at the carts, and you make a strategic decision. You switch lines, but suddenly the person in front of you needs a price check. The register runs out of paper. Meanwhile, the line you just left is moving perfectly. Over a lifetime of switching lines, you will not save time. You will simply just average out to the mean wait time, except you will have exhausted yourself with the stress of constantly trying to optimize. You are paying a switching cost in effort and anxiety for a result that is no better than if you had just picked a line and stood still. If logic and probability are not enough to dissuade you from the fantasy of stock picking, we must turn to the undeniable evidence. In the financial industry, there is a report card that comes out every year. It is called the SPIVA scorecard, which stands for S&P Indices versus Active. It is the most comprehensive audit of the investment world, and its results are devastating. The data reveals that over a 15-year period, approximately 90% of active fund managers fail to beat their benchmark index. Let that number sink in. These are professionals with the best education, the fastest computers, and the deepest pockets in the world. And 9 times out of 10, they lose to a simple, brainless algorithm that just buys every stock in the list. If you went to a surgeon who failed 90% of the time, you would not call it a profession, you would call it a scam. Yet in finance, we pay billions in fees for this level of performance. Why is the failure rate so consistently high? Is it because these managers are incompetent? No. It is because they are fighting a mathematical headwind known as cost drag. This is the silent killer of wealth. Imagine a sprint where one runner wears running shorts and the other wears a 20-pound weighted vest. That vest is the fee structure. If the stock market returns 8% in a given year, an index fund, which costs almost nothing to run, will give you virtually that entire 8%. But an active manager charges an expense ratio, often around 1%. Furthermore, because they are active, they are constantly buying and selling stocks. Every trade incurs transaction costs and, more importantly, triggers taxable events. This hidden friction can easily add another 1% in drag. So, the active manager starts every year in the hole. Before they have even logged in, they are down 2% relative to the index. To simply break even with the market, they must find stocks that outperform the average by a significant margin. To actually beat the market, they have to take on excessive risk. They are forced to swing for the fences just to cover the cost of admission. Most retail investors shrug at a 1 or 2% fee. It sounds trivial. We think, I keep 98%, they take 2%. That's fair. But this is a catastrophic misunderstanding of compound interest. You are not paying fees on your profit, you are paying fees on your total capital every single year, regardless of performance. Over an investing lifetime of 30 or 40 years, a 2% fee structure does not reduce your end portfolio by 2%. It consumes between 25 and 30% of your total potential wealth. That is 1/3 of your retirement gone, transferred from your pocket to a fund manager's yacht. This is the croupier's cut. In a casino, the house always wins, not because they rig the cards, but because they take a tiny slice of every pot. Wall Street is a machine designed to monetize activity. They need you to trade. They need you to believe that the market is a complex, dangerous jungle that requires a sophisticated guide. They sell you complexity because complexity justifies high fees. But the data proves that the guide gets lost 90% of the time and still charges you for the map. Active investing is not a strategy, it is a voluntary tax on your future. Simplicity generates wealth for you, but it generates zero revenue for Wall Street. That is why they hate it, and that is exactly why you should embrace it. So, if the game is rigged, the math is against you, and the professionals with billion-dollar algorithms cannot even beat the averages, what is the answer? The answer is to stop playing. The only way to win the game is to realize that it is not a game of skill, it is a game of participation. We arrive at the philosophy championed by John Bogle, the founder of Vanguard, who revolutionized the financial world with a simple maxim. Don't look for the needle in the haystack, just buy the haystack. This is the essence of index investing. Instead of trying to pick the 5 or 10 stocks that you hope will be the winners of the next decade, you simply buy a fund that owns a piece of every major company in the economy. You buy the S&P 500 or a total world stock market fund. You become a partial owner of the entire capitalist system. The biggest psychological barrier to this approach is the word average. In every other area of life, we are taught to strive for excellence. We want to be above average. We want to be exceptional. So, when an index fund promises market average returns, our ego rejects it. We think average means mediocre. But in the world of finance, this is a linguistic trap. Because the majority of active investors lose money to fees, bad timing, and poor selection. Receiving the average market return actually places you in the top 10% of all investors over the long term. Being average makes you elite simply because you refuse to make the unforced errors that everyone else is making. By buying the index, you also solve the problem of risk. In investing, there are 2 types of risk. The first is idiosyncratic risk. This is the risk that a specific company, say Enron or Blockbuster, will fail due to fraud, mismanagement, or technological obsolescence. If you pick individual stocks, this risk is high. The second is systematic risk. This is the risk that the entire economy will collapse. By buying the index, you completely eliminate idiosyncratic risk. If one company in the S&P 500 goes bankrupt, it is automatically removed from the index and replaced by a growing company. You don't have to watch the news. You don't have to analyze balance sheets. The index is self-cleansing. You're left only with systematic risk, and if the entire global economy goes to zero, your stock portfolio will be the least of your problems. This brings us to the ultimate benefit, which is not financial but psychological. Peace of mind. The passive investor does not care who the president is. They do not care about interest rate hikes. They do not panic when a CEO is fired. They treat their investments like a monthly bill. They automate a transfer from their paycheck into a low-cost index fund, and then they go live their life. They sleep well at night, knowing that the relentless engine of global innovation is working for them while they rest. There is a profound irony at the end of this journey. The stressed, high-energy trader who monitors 6 screens, reads every financial report, and wakes up at 4 a.m. to trade the European open will with near mathematical certainty, end up poorer than the lazy, uninformed investor who simply buys the index once a month and never checks the price. In the world of investing, excitement is expensive, complexity is a sales pitch, and boredom is the most profitable strategy of all. The goal is not to beat the market. The goal is to be the market and let the market make you rich.